in their wallets. Wages grew last year, but this growth has not kept pace with rising costs for housing, for gas, for groceries. Georgia families are swimming upstream, and while supply chain disruptions contribute to the problem, they are not the sole cause. 3 global shipping alliances control delivery from the majority of imported goods. 2 companies account for 70% of America's diaper market, and just 4 meat processors control more than 80% of the beef industry. This type of market concentration lowers competition and gives giant companies more power to use inflation as an excuse to raise prices, leaving Georgia families to foot the bill while their executives and investors get richer and richer. This is why I've pushed for a federal investigation into apparent price gouging by international cargo carriers, carriers that have seen as much as 2,000% increase in profit in the midst of a pandemic. Chairman Powell, yes or no, do you agree that more market competition is generally good for the economy and for consumers?
I do.
And that too much market concentration poses a risk that consumers can feel and are feeling, in fact, right now with rising prices?
I think that's an appropriate, concentration is an appropriate subject for the competition authorities.
But does market concentration pose a risk for rising prices, yes or no?
Yes, I wouldn't want to be heard to say, though, that I think that's the main source of inflation, but it certainly is.
So do you believe there is a role for the Federal Reserve to promote market competition to help ease inflationary pressures?
So we don't, outside of the banking industry, we don't have a role in competition policy as such. We do administer statutes that bear on that, but ultimately, though, our jobs are inflation and maximum employment, as you know very well. The industries that you're talking about and the kind of issues that you're talking about really are for the antitrust people rather than for monetary policy.
Right, but dealing with inflation is part of your mission and your mandate. And if market concentration is contributing to that, doesn't that involve the Fed's mandate?
But we don't have the tools to deal with market concentration, and it's we're supposed to achieve maximum employment and price stability. That's the classic role for the antitrust people at the FTC and the Justice Department and at the state level, rather than for us.
Will you commit to a study on how market concentration has affected the price of consumer goods during the pandemic and share that study with Congress and antitrust enforcers?
So I think I can do better than that, which is we actually have a good amount of research from inside the Fed and from outside the Fed that bears on these questions, and we'll be happy to share that with you right away.
All right. Thank you so much. I look forward to working with you to address the root causes of rising costs for Georgia families, for American families in general. All right. Mr. Chairman, I've got 50 seconds left, but I'm going to defy Baptist preacher gravity. That's the end of my question.
Thank you, Senator Warnock. Senator, follow that advice, Senator Rounds from South Dakota.
Thank you, Mr. Chairman. Mr. Chairman, first of all, thanks for what you do. Appreciate it and appreciate your openness with us. I want to go back and kind of simplify a couple of things if we can a little bit, just in terms of the issues surrounding inflation. I think it's fair to say that if you divide it, one way you could divide it is into 2 parts, one being the supply side pressure on inflation, and the second side being the demand side. I think the last time that you were here before this committee, we talked about the fact that the Fed really had the ability to impact the demand side. Fair to say that that's where most of your capabilities are today, or
yes, very much so. Yeah.
In order to do that, and I know that the question is trying to get inflation down to 2% or so. What what would you say is of the total amount? Right now, we're running 7.5%. How much of that can the Fed actually impact with their policies? What part of it is demand-driven versus supply-driven in the analysis that you do?
That's a really interesting question. I don't have a precise answer for that. I think it's clearly both, and that's why I would say to get back to 2% inflation, we really do think we're going to need help from the supply side in the form of just the bottlenecks and shortages and all that being alleviated as well.
When you make a determination as to the tools that are available to you, in particular, primarily raising in the basic interest rates that are available to you right now, how much of that inflation do you think you can impact using the tools that you've got right now? What I'm pointing is it seems to me that if we decided that the tools that you have are available to fix all of inflation, we put you in a really tough spot, and we may very well go way overboard on the amount of interest increases and not be able to actually impact a significant part of the inflation itself. A fair concern to have?
Yes, so I think we need to bear in mind, and we will keep in mind that some of this is because of very strong demand meeting a limited supply, an inflexible supply. Mm-hmm. Cars is a great example. Ordinarily, if there's demand for cars, a lot of demand, the car makers go, this is great, we'll make more cars, and we'll raise the prices too. If you can't make more cars without more semiconductors, right? You can only make the amount that you're making, and so what happens is it all goes into higher prices. So, we can lower car demand by raising rates, and we'll do that. But ultimately, we need more semiconductors so that there can be more cars as well to really get back to 2% inflation.
Fuel costs have got up in some cases 40% in the last year, though. You can't really impact.
No, we can't.
That portion of it.
No. Well, I mean, we can impact demand, but really these prices are set at the global level, by and large, and so it's really we can't affect it.
The section of the monetary policy report on our debt and deficit explains that due to the extreme federal spending, the federal deficit surged by 15% of nominal GDP in 2020, and federal deficits are expected to increase by roughly $5.4 trillion by the end of fiscal year 2030. Federal debt by the public jumped to above 100% of nominal GDP in 2020, the highest debt to GDP ratio since 1947. And it remained there in 2021. If the Fed is slated to raise interest rates potentially more than 5 times this year, the interest on the federal debt will also rise, further ballooning the national debt. What effect does a ballooning national debt have on the economy, and how does the Fed factor that into its forecasting of that portion of the challenge?
It doesn't have our unsustainable fiscal path doesn't really have a bearing on we work in business cycle limit. That's sort of the time frame we can think about things given our tools and what they do. We are on an unsustainable fiscal path, meaning that the debt is growing faster than the economy. That, by definition, is unsustainable in the long run. We need to get back to that, but the time to do that is when the economy is strong, and that's really all I can say. That's all I can say about it.
Okay. One last question. That's this week the Fed announced a proposed plan to improve the process for financial institutions looking to get access to Fed master account. Seems unique that it would happen right now with everything else going on with regard to nominations here before us. Would it suggest that the Fed believes that the process has been abused in the past, or is this just an arbitrary determination being made right now? What's the reason for this investigation?
Well, it's just we've had burgeoning. It's really the digital finance and all the new kinds of charters and all of those things, and there's a need for us to, and we took we put a lot of time and thought into to the extent to which we should provide master accounts to fintechs that may or may not have deposit insurance, and it's highly precedential, and we wanted to get it right. So this is we've been thinking about this for a long time, as one of your colleagues knows well, and this is a proposal. It's out for comment, I think, for 45 days, and it gives sort of 3 tiers, and we want to get public feedback on that. But I think it's taken us a while to get to this. There's no magic to the timing, but It's just a reflection of what's going on in the world of digital finance.
Very good. Mr. Chairman, thank you.
Senator Rounds.
Thank you, Mr.
Senator
Chairman.
Reed from Rhode Island is recognized.
Thank you, Mr. Chairman. Thank you, Chairman Powell, for your great work. And Senator Cortez Masto has raised the issue of housing. And for families all across the country, particularly my home state of Rhode Island, this is one of the biggest forms of inflation they're seeing. It's been reported that housing prices year over year have gone up 20%. Rent in nationwide in January rose 14% in 2021, the last numbers we have. But I had school principals in yesterday, and they were commenting about some of their families have to leave a working class community in Rhode Island because they can't afford the housing, and this is in luxury housing, to go into poor neighborhoods just to have some shelter. And I'm afraid there's another factor that's going to really exacerbate what's going on, and that is private equity and Wall Street have decided that they're going to buy up as many homes as they can, and that disrupts what we assume is the typical housing market for both rental, i.e. Relatively small owners have rental properties in the state. They have a relationship with their tenants. When it comes to homes, you buy a starter house and then you move up and you sell it. And these are families through a realtor selling it. Now we've got the big machines that are just buying up houses, throwing people out. And I think that's something that's going to essentially sneak up on us like the derivatives crisis and a lot of other crises in the past. But what you're going to do, and in your authority, is address the demand side of the economy. This is really a supply side issue. I would assume you'd agree.
Yes.
But if we do not address it, we will see continued inflation in housing and continued problems, and that's contributing significantly to the overall inflation rate. Is that accurate?
Well, I think in housing, you've got it's land, labor, lots, materials, and it's very strong demand. All of those are scarce, and it's very strong demand hitting that, and so that's why you're seeing prices.
Well, now, will the interest rate increases, do you think, affect demand for housing?
I expect they will. Yes. It's a very interest-sensitive sector.
Yeah, and so that will home ownership. In terms of rental housing, that typically, because of the supply shortage, will be passed on to the renter, I would assume.
Yes.
Yeah. So, we have a problem that affects families all through this country, and one of the consequences of what you're going to do is raise prices at least slightly, but we have to deal with it, and that's on the supply side. I know that's not your bailiwick, but we're talking in general terms about inflation, and if we don't get a handle on housing inflation, the American people will still be, and particularly the lower income working families, will be hammered by this. So I hope we can come together on the fiscal side and do something that's appropriate. We are witnessing an extraordinarily disturbing conflict in the Ukraine, and it's going to have repercussions in many different dimensions. I think it will also have repercussions in the financial world, and I hope the Fed is tuning in and watching closely. I think the Chinese are particularly interested in the fact that we've been able to assemble a global coalition to basically shut down the Russian economy, and they will start thinking about how they can avoid that fate if they get into a similar circumstance. They have, I think, a rudimentary SWIFT system, which they might try promoting much more, which could interfere with the system that we have invested. Then cryptocurrency, it will be exploited. I think also, too, that the whole issue of the dollar as the medium of exchange for the world, which is the key that is really making our sanctions effective, the Chinese, again, will look very closely, as they have in the past. So first, I presume you're going to look at this issue very closely, and second, inform us of what developments, and then third, you might just indicate what you think might happen.
Yes, yes to all of the above. It's I mean, you're asking some longer-term questions
Right.
about the reserve currency and the Chinese messaging system that is like SWIFT. In the near term, those are not going to be big questions in this one particular instance. But in the longer run, I think those things are very much on the table.
And so we will see at some point, and again, not in months, but probably years, movement, particularly by the Chinese, to insulate themselves from the same thing that they're observing in Russia now.
And that's going on now. I mean, that's been going on for some time. So, this may change the trajectory.
It's an accelerant.
Yeah.
Thank you, Mr. Chairman. Thank you very much.
Thank you.
Thank you, Senator Reid. Senator Sinema from Arizona is recognized from her office.
Thank you, Mr. Chairman, and thank you to Chair Powell for being here today to speak about these important issues. As you know, over the last 2 years, we've seen the significant impact of the COVID-19 pandemic on our global supply chains for both industrial and consumer goods. While our economy is beginning to recover, we are already seeing the impact that Vladimir Putin's illegal, violent attack on Ukraine will have on the price of oil and gas here at home. I'm supportive of the strong, swift actions the administration has taken to sanction major Russian banks and Russian oligarchs in response to the unprovoked war that Russia is waging against Ukraine. I can believe we can go farther and do more. I'm also mindful of the impact that these sanctions are having and will continue to have on everyday people, not just in Russia and Ukraine, but also here at home. These sanctions can affect the availability and pricing of essential goods for hardworking Arizona families by further disrupting global supply chains. Let me be clear, Arizonans stand with Ukraine in their fight to determine their destiny. We are supportive of the actions taken thus far to hold Russia accountable. And Arizonans are also concerned with the price of groceries and everyday goods, and we're paying too much at the pump right now. So in a global economy, sanctions often involve economic trade-offs. How is the Fed assessing the impact of Russia's illegal war and the U.S. and allied sanctions against Russian banks on the pricing of oil and gas for consumers?
Thank you. So, oil and gas prices have been going up really for a couple of months now in anticipation of this, and then they've gone up substantially in the last couple of weeks. And, the really important question for the economy is how long that will persist. The immediate impact will be to raise gas prices and other fuel prices and prices for companies using energy. So inflation will move up. People will feel that, certainly at the gas pump. And also, crudely, a little bit, you would expect at least a little bit of lower economic activity due to higher energy prices. But again, it's both the magnitude of that full, and that will really depend on events that haven't happened yet. How big will those increases be? And secondly, how long do they persist? If they are brief and go away, or if just the price of oil stays at a certain level for a while, then the effect on inflation will be temporary. So we'll be watching all of those things, and we run simulations and that sort of thing. That's one of the things we like to do, and so to make ourselves think about the possibilities. Of course, everything is so uncertain. It's just very hard to say where this is going, and I think in that environment we need to move carefully with our policy, and that's what we're planning to do.
How much do you expect these changes in oil and gas prices to affect the availability and pricing of other goods that rely on oil and gas in the U.S.? And do you expect there to be a noticeable impact in the consumer price index?
I think temporarily, you'll see gas prices move up as they do when oil prices go up, and that'll show up in the consumer price index. It'll show up in the headline index. It doesn't show up in the core index, but it shows up in the headline index. And the headline index, of course, is what people are actually paying at any given time. So It will show up.
Does Russia's war in Ukraine change the Fed's thinking about interest rates?
Too early to say. I do think before the invasion, We were planning to raise rates this year. We were planning to make a series of interest rate increases. That is still the case. I think right now, in this very sensitive time where uncertainty is highly elevated and we really don't know which way things are going to go, I think we need to move carefully. But we certainly think it's appropriate for us to go ahead with our plan, and also our plan to shrink the balance sheet, but just knowing that we do not want to add to uncertainty. Our goal is always to promote financial stability and macroeconomic stability, and that means that at times like this, we move carefully, and that's what we'll be doing.
Last question. The sanctions on Russia's central bank are also affecting American companies who have holdings in Russia. So what assessments are the Fed making about the impact of American companies' dealings in Russia, and how could the Fed respond to stabilize the markets if that does become an issue?
So particularly the large financial institutions, but really American businesses generally, really do not have major exposures to Russia. And they've gotten less over the years. So we particularly with the big banks, there are some meaningful exposures, but they're not large in the context of the overall institution. So in a sense, the first order effects on the U.S. economy from trade or from investment or from operations on the ground are not going to be large. There can be other effects, though, second-order effects, and unintended consequences and all that. So we're watching the situation very carefully.
Thank you. Mr. Chairman, I see my time's expired. Thank you.
Thank you, Senator Sinema. Thank you to Senator Powell for joining us today. For senators who wish to submit questions for the hearing record, those questions are due 1 week from today, Thursday, March 10th, close of business. Chair Powell, please submit your responses to questions within the 45 days. From the day you received them. Thank you again for your testimony. The committee is adjourned.